Look at any asset's price chart over time, and you'll quickly notice it rarely travels in a straight line. Instead, it moves through a continuous series of peaks and troughs, building and releasing kinetic energy, just like a roller coaster. Swing trading is a strategy designed to capitalize on that exact movement. The goal is to hop on right before a significant climb or drop, and then exit to collect your profit before the momentum fizzles out. This is a distinctly different approach than day trading, where day traders buzz in and out of the market to catch tiny, frequent gains before the closing bell. A swing trader acts more like a patient surfer, waiting to catch one really good large wave. To catch the full value of that predicted move, swing traders hold their positions much longer, keeping them open overnight or even for several days to weeks. Because these trades develop at a slower pace over an extended time frame, you don't need to stare at a screen all day long. That makes this a highly practical active market strategy for people working standard 9-to-5 jobs. But the decision to hold assets overnight alters the mechanics of how you trade. For one, the leverage or margin limits that a broker is willing to offer you might differ significantly from standard intraday trading. And when you step away from the daily market bell, you have to replace minute-by-minute anxiety with something far more reliable. You have to depend on calculated mathematical chart reading to guide those extended trades. To find their exact market entry points, swing traders actively block out external news and distracting market gossip. They look strictly at math, historical charts, and volume data to form their strategy. This animated chart demonstrates breakout trading. Watch the price bounce between two barriers, a support floor and a resistance ceiling. When buying volume gathers in math momentum, the price smashes upward through the resistance ceiling, signaling traders to buy in. But if trying to pinpoint the exact moment of a breakout feels too precise, traders often turn to trend trading. Instead of guessing the exact beginning or end of a price swing, trend traders look for an established upward or downward movement. They jump into the market while the trend is already happening, grabbing a slice of the action before stepping out. Both of these strategies require you to accurately measure the strength of market momentum. And to do that, traders rely on a specific mathematical toolkit. This style represents the Relative Strength Index, or RSI. It acts like a speedometer, measuring trend momentum from 0 to 100. When the needle hits 70, it triggers an overbought signal, suggesting the asset is overpriced and due to cool down. This line graph displays moving averages, comparing a fast 50-day average to a slower 100-day average to confirm trend strength. When the fast line crosses directly above the slower line, a bullish green light illuminates, signaling prices are heading up. Finally, there is the stochastic oscillator. Operating on a similar 0 to 100 scale, it usually looks at a 14-day window to act as an early warning radar, showing momentum shifts before the market volume actually peaks. While these mathematical filters provide a vital statistical edge against market noise, they can lag behind real-time events or produce false alarms. They are useful tools, but they do not predict the future perfectly. Developing the intuition to read these charts effectively takes years of consistent study and practical experience. But the primary structural danger of the swing strategy comes from the clock itself. You are holding assets overnight while you sleep and the markets are closed. This chart illustrates a phenomenon known as gapping. It happens when major news breaks during off hours, causing the market to reopen the next morning at a price that skips over your intended exit, leaving a visible vertical disconnect between the candles. If you are caught on the wrong side of that gap, the damage is immediate. And if you are using leverage, borrowed money from your broker to pump up your trades, that leverage acts as a magnifying glass, exponentially increasing your financial loss. The combination of overnight market exposure and heavy leverage means an unexpected gap can wipe out a trader's portfolio in a single morning if left undefended. To survive the unpredictable drops of the market, traders cannot simply rely on hope that a trend will continue. They must use strict, disciplined risk management. The most common defense is the stop-loss order. It acts as a financial seatbelt that automatically cuts losses at a predetermined price before they magnify. Profitable swing trading is built on using mathematical filters to find the right wave and using these strict safety nets to survive the wipeout.